Right now, as we speak, Navitas Semiconductor is trading at $8.95, surging up over 7% on the intraday chart, and the market is absolutely buzzing with a mix of confusion and adrenaline. If you are watching the ticker tape on your screen, you are seeing a stock that refuses to sit still, oscillating between 890 and 910 in a violent tug-of-war between bears who are fixated on the past and bulls who are betting on a very specific, high-energy future. Most people looking at this chart today are expecting a simple story. They see a semiconductor company in the middle of an artificial intelligence boom and assume it should be flying high alongside the giants. The expectation is that because NVIDIA stock has redefined market capitalization records, every chip play should be printing money. But the reality with Navitas is significantly more complex, more dangerous, and frankly, more fascinating. The reality is that this company is currently executing a high-stakes pivot that has terrified the short-term thinkers while quietly attracting a very specific type of long-term capital. While the retail crowd on Robinhood might be chasing the daily momentum, seeing that green percentage sign and jumping in, the institutional money flowing through Fidelity Investments is looking at a completely different timeline. Today's 7% move isn't just noise, it is a reaction to a structural shift in how the market views power delivery. And if you are not paying attention to the specific mechanics of gallium nitride, or GaN, you are missing the entire plot. Let's back up and look at the immediate price action, because understanding today's volatility is key to understanding the stock's character. We opened this morning around 8:53 and almost immediately buyers stepped in. This wasn't a slow, grinding ascent, it was a sharp vertical move that caught a lot of short sellers off guard. You have to remember that Navitas has a short interest hovering near 20%, which is incredibly high. That means 1 in 5 shares sold short is a coiled spring waiting to snap back. When you see a move like we are seeing today, up 7, maybe 8% intraday, you are watching those short sellers sweat. They are calculating their margin calls, checking their Interactive Brokers account balances, and wondering if today is the day they get squeezed out. This creates a curiosity loop. Why is the stock rallying now? Especially after a third-quarter earnings report that, on the surface, looked disastrous. The company reported revenue of just over $10 million, which was a massive drop compared to the $21 million they pulled in the same quarter last year. If you only look at the headline numbers, you would think this company is imploding. That is the expectation I mentioned earlier, the belief that shrinking revenue equals a dying business. But here is the reality that is driving the price up today. That revenue drop was intentional. It was a strategic exit from low-margin mobile phone charger businesses to focus on the high-power, high-margin world of AI data centers and electric vehicles. The market is finally waking up to the fact that Navitas isn't trying to sell phone chargers anymore. They are trying to power the grid that runs the future. When you compare this to the broader sector, the distinction becomes even sharper. Most investors have their portfolios heavily weighted in Apple stock or are constantly checking the price of Tesla stock, looking for consumer-facing wins. But the infrastructure that supports those ecosystems is where the real engineering wars are being fought. Navitas is a pure play on next-generation power electronics. Unlike silicon, which has been the standard for 50 years, Navitas uses gallium nitride. I want you to picture silicon like a standard sedan engine, reliable, ubiquitous, but it has a speed limit. GaN is like a race car engine. It runs faster, handles higher voltages, and most importantly, it generates significantly less heat. Heat is the enemy of electronics. In an AI data center, heat is what prevents you from stacking more chips together. By switching to GaN, data centers can run more efficiently, using less power for cooling and more power for computing. This is why the recent partnership with Global Foundries is such a massive catalyst. It validates the technology at a manufacturing scale that few competitors can match. If you are sitting at home managing your Schwab Intelligent portfolios, you might not see gallium nitride listed as a sector, but it is rapidly becoming the bottleneck that needs to be solved for the AI narrative to continue. We need to talk about the specific news that is adding fuel to today's fire. Just recently, Navitas announced an expanded strategic partnership with WT Microelectronics in Asia. This might sound like boring supply chain news to the uninitiated, but let me translate what it actually means. Asia is the manufacturing hub of the world. By consolidating their distribution with WT Microelectronics, Navitas is essentially streamlining their path to the biggest customers on the planet. They are cutting out the middle management clutter and creating a direct pipeline for their chips to get into the hands of engineers who are building the next generation of servers and EV chargers. This news, combined with their recent $100 million capital raise, tells us management is gearing up for a fight. They have cash on the balance sheet, around $150 million, which gives them a runway. In the world of high-growth tech, cash is oxygen. Without it, you suffocate before you can finish the race. Navitas has secured enough oxygen to sprint for the next few years, and that removes the immediate bankruptcy risk that bears were betting on. Now let's look at who is actually buying this stock. It's a mix of high-frequency traders exploiting the volatility and long-term believers in the electrify everything thesis. If you use SoFi Invest or similar investing sites, you have probably seen the chat boards lighting up with debates about whether this is the bottom. The stock has traded in a brutal range over the last year, dropping from highs near $17 all the way down to $1.52 at the low. Think about that destruction of value. If you bought at 17, you are hurting. But if you are looking at it today at $8.95, you are seeing a stock that has quadrupled off its lows. That kind of V-shaped recovery is rare and usually signals a change in sentiment. It suggests that the market believes the bottom is in and the turnaround story is valid. However, you must be careful. This is not a stock for the faint of heart. The beta, a measure of volatility, is high. If the Nasdaq sneezes, Navitas catches a cold. If Tesla stock drops 5%, Navitas might drop 10%. It's amplified. This is why having a solid investment strategy is crucial. You can't just throw money at this and hope. You need to understand that you are buying a call option on the adoption of a specific chemical compound, GaN, over silicon. I want to pause here and ask you a question, because this community is smarter than the average Wall Street analyst gives them credit for. Comment below how many shares of Navitas you currently hold, or if you are waiting for a dip back to $7 before entering. I am genuinely curious if you guys are playing the swing trade or if you are holding this for a 5-year horizon. Let me know in the comments. Continuing with the analysis, we have to address the competitive landscape. Navitas is not the only game in town. They are fighting against established giants and other scrappy upstarts like Wolfspeed or onsemi, although those companies focus more on silicon carbide, or SiC. Navitas does both, but their crown jewel is GaN. The difference matters. SiC is great for really high voltage stuff like massive industrial motors or the main drivetrain of a Tesla. But GaN is the sweet spot for onboard chargers, data center power supplies, and consumer electronics. It's faster. The bet you are making with Navitas is that GaN will steal market share from silicon faster than analysts predict. There is a concept in technology adoption called the S-curve. We are currently at the very bottom of the S-curve for GaN. It's just starting to be adopted. If Navitas can maintain its leadership position as that curve goes vertical, the current revenue numbers will look like a rounding error in 5 years. But that is a big if. Execution risk is real. They have to manufacture these chips perfectly. Yield rates have to be high, and they have to convince skeptical engineers at major auto manufacturers to switch away from the silicon they have used for decades. Let's discuss the mechanics of how you might trade this if you are an individual brokerage account holder. If you are using a Fidelity trading platform or Interactive Brokers trading setup, you have access to tools that can help you manage risk here. Given the volatility, some traders use options to hedge, others use dollar-cost averaging. Because Navitas moves so violently, trying to time the perfect entry is almost impossible. You might buy at $9 today and it could be $8.50 tomorrow, then $9.70 the next day. This whipsaw action is typical of stocks in a transition phase. The Navitas 2.0 strategy that the CEO talks about is precisely this transition. They are shedding the low-margin skin of the past to grow the high-margin wings of the future. The market hates uncertainty, which is why the stock was punished so hard previously. But now, with the partnerships locked in and the capital raise secured, the uncertainty is fading, replaced by a roadmap, and markets love a roadmap. There is also a macro angle here that we cannot ignore: interest rates. High growth